Hi everyone. In this video, we are going to practice preparing a classified balance sheet. So, below is information taken from the adjusted trial balance of Blue Devil Inc. for the year ended December 31, 2019. Prepare Blue Devil Inc.'s classified balance sheet. And there's a note on here. Note, the bonds mature in 2 years. So, a couple of things I want to just go ahead and point out right out the gate to make sure that you can get through this okay, depending on what your skill level is at the time that you're trying this practice problem. If you are unfamiliar with what an adjusted trial balance is, that is a collection of the ending balance of most of the accounts in the company, and that's going to be used to make the financial statement. So that's just where this information is coming from. It tells you the company, it tells you the point in time. It asks you to prepare the classified balance sheet. So remember, asset, liability, equity, not good enough. You got to use the subcategories. They give you a note on here. The bonds mature in 2 years. Bonds are debt instruments. And when we talk about maturing, all this means is it's a debt that is scheduled to be paid back in 2 years. Two other things to note down here in the adjusted trial balance information. You're given retained earnings. If you're familiar with the adjusted trial balance, you know that retained earnings on the adjusted trial balance is actually the beginning retained earnings, not the ending. It's the only account where you're getting the beginning balance. Everything else is an ending balance. And you'll notice one other little comma entry here, accounts receivable net. And don't let that throw you off if you see the word net there. If you're familiar with receivables, you know that companies will account for the portion of receivables they don't think they're going to collect. And so by saying accounts receivable net, we're just saying, hey, this has been adjusted for the portion of receivables we don't think we're going to collect. But you treat it just like you would treat accounts receivable. All right, I believe that is all of the clarification I need to give up front. So grab a blank sheet of paper, grab a pen, grab a calculator, try preparing the classified balance sheet all on your own, and then when you're ready, come back and I'll walk you through the solution. All right, welcome back. So here we go. If you've watched enough of my videos, you know that anytime I have a problem of this nature, I just like to get organized when we first start. We're preparing a financial statement, and all financial statements require a header. So I'm going to start with my header, Blue Devil Inc. That's the company. Then you put the financial statement name. In this case, it is a balance sheet. And you want to put the period or point in time covered. In this case, balance sheet is a point in time at 12/31/19. All right, that takes care of my header. I also like to organize all of the given information. And so let's go ahead and check out what we've got over here. First up, retained earnings. This is beginning retained earnings. Now, retained earnings is going to go in the shareholders equity section of our balance sheet. There are no subclassifications to shareholders equity, so that's just it. It goes in shareholders equity. But I am going to put an asterisk on this just to remind myself that, hey, that's beginning retained earnings, and I need ending, not beginning. So I need to go ahead and just kind of make myself aware to come back and revisit that. Next up is cash. Cash is the most liquid asset a company has, so that goes into current assets. Next up is bonds payable. So this is your debt instrument. Payable says you owe this, and here's where that note up top is going to come into play. It says the bonds mature in 2 years. In other words, you're paying it back in 2 years. So because this is a payable, it's a liability. And because we're not paying it back for 2 years, it is specifically a long-term liability. All right, we've taken care of our note, so I'm going to go ahead and put a check mark up there just to remind ourselves that, hey, we've done that. Common stock, all stock accounts show up in shareholders equity. Accounts receivable net. Accounts receivable is when your customers owe you money, so that's something of value to you. And it is highly liquid because your day-to-day customers don't take more than a year to pay you, so that is a current asset. Operating expenses. So these are just the general expenses for the company to operate. Expenses do not go on the balance sheet. They go on the income statement. So I'm going to mark that as expense, but I'm going to go ahead and strike it because that line will not show up on our balance sheet. Next up, buildings. Buildings belong to a special category of assets called property, plant, and equipment, or PP&E. Unearned revenue. Now, don't be too quick to see that word revenue and strike this out as going on the income statement. Anytime revenue is paired with the word unearned, what that is telling you is that you've gotten paid. It's going to become revenue. However, you still have a task to fill. You can't call that revenue yet because you haven't earned it yet. And so by saying that you have a task to fill, it's saying you have an obligation. You owe something to someone to claim this revenue. It is unearned. And so that's a liability. Typically, people don't pay you over a year in advance, so those are typically current liabilities. Sales revenue, now that's just legitimate revenue that goes on the income statement. And so we're going to strike it. Next up, accounts payable. The word payable gives it away. That's a liability. Accounts payable is your liabilities from your day-to-day business. You typically pay pretty quickly, not any longer than a year, so that's a current liability. And last up, equipment, another one that falls into our special category of large tangible assets called PP&E. It's in the name, property, plant, and equipment. That's what the E stands for. And so that's it. We've gone ahead and categorized everything. We've stricken the things that we need to strike. We've got our asterisk to note that we have to deal with retained earnings when we get there. And we've got our header to kick off our balance sheet. Now we can get started assembling. So first section, assets. First category under assets is going to be current assets. I'm just going to put CA for short. Under current assets, we have identified the cash of $151,000 as well as accounts receivable of $75,000. You're going to put your current assets in order of liquidity. Cash is always the most liquid account that you have. And then we have our accounts receivable after that at $75,000. Those are the only current assets that we identified, so we are going to go ahead and total that up. Total CA, and it looks like that's going to be 156, 226, I believe, thousand. After our current assets, we deal with our long-term investments, and it looks like we did not identify any long-term investments, so we can just skip that section altogether. After that is going to be our PP&E. We did identify two pieces of PP&E, buildings and equipment. You're typically going to list these in order of magnitude. So I'm going to put PP&E, and then I'm going to list the buildings look like they're the most expensive at $200,000. And then the equipment is next at $70,000. And that's the only two we had, so I'm going to go ahead and total that up, $270,000 total PP&E. Now, I would like to point out here that I kept this problem simple by just giving you PP&E. I didn't give you any accumulated depreciation. Accumulated depreciation is a contra account that shows you how much of the value of PP&E has already been lost. In the event that you had accumulated depreciation, it would have just been slipped in right beneath each item that it went with. So the accumulated depreciation for the building would have shown up right below building as a subtraction. The accumulated depreciation for equipment would have shown up right under equipment as a subtraction. So I didn't give it to you here to keep things simple, but had you had it, that's what you would have done with it. After PP&E comes intangible assets, and it looks like we do not have any intangible assets in this problem, therefore we can skip it. That brings us to the final line of our asset section, total assets. And it looks like if we add all of this up, we've got $496,000 in total assets. All right, now I didn't do it as I went along, and I should have, so I'm going to quickly go to the left over here. I'm going to check off, we used our cash, we used our AR, we used our building, we used our equipment, and I believe that's all we've used so far. So that way we're fully caught up on what accounts we've used up till this point. So we've got to do liabilities next. I'm going to copy my notations over here and bring them with us to the next slide. Just bear with me while I get these in place. There we go. Alrighty, so liabilities. Liabilities only have two classifications. That's your current liabilities and your long-term. So we start with current liabilities. If we take a look at our accounts, we have identified unearned revenue as a current liability and accounts payable as a current liability. Typically, what you will be taught in your accounting textbooks is in current liabilities, any notes will go first, any accounts payable will go second, Unearneds will go third, and then anything else that's miscellaneous will go in order of magnitude. So in this case, we have accounts payable, that ranks number 2. We don't have any notes, number 1. And then we have an unearned, that's number 3. So we're going to put them in that order. Put accounts payable for, what was that, 5,000. And then we're going to put unearned rev 40,000. Note that these are not in order of magnitude, right? This is just, it has a certain little rule set that's typically followed. Notes, then AP, then unearned, then you go order of magnitude. But that's the only ones we have. So I'm going to go ahead and subtotal that, 45,000 total CL. And I'm going to check those off that we've used them. Done with that. Next up is long-term liabilities. So LTL, and I believe we only identified one of those, and that was our bonds worth 20,000. So BP stands for bonds payable, 20,000, and that's the only line item we have in long-term liabilities. If you only have one line item, there's no need to do a subtotal. It's redundant, so we can just move on at that point to doing total liabilities. So total liabilities, and that is going to tally out to $65,000. Brings us to our final section, our shareholders' equity. I'm just going to abbreviate SE for ease. Your stock goes first. In this case, we had common stock worth $350,000. And then the final account we have to deal with are retained earnings. But remember, we need ending retained earnings, not beginning. So now we're going to have to do a little math. We know that retained earnings looks like this: beginning RE plus net income minus dividends equals ending retained earnings. So we already have our beginning retained earnings of $56,000. We also know, looking at the items that were stricken out, that we had revenue of $115 and expenses of $90. If we subtract those two, that gives us a net income of $25,000. So plus net income, $25,000. The problem did not tell us anything about dividends, did not give us any indication that there may have been dividends, no values related to dividends. We will assume that that is 0. And therefore, our ending retained earnings comes out to $81,000, and that is the amount we are going to use on our balance sheet, $81,000. Now we tally up our total shareholders' equity, which is going to come out to $431,000. And don't forget one last step, total L plus SE. Our 431 SE plus our 65 L gives us $496,000. We want to make sure that we compare that to our total assets. They match. We are good to go. All right. This was a long one, and there were a lot of moving pieces, but I hope you found it helpful, and I hope you join me for more.